Welcome to The Debate.
Hello.
Our focus today is on the complex and frankly paradoxical state of the gold and silver bull markets. We're seeing this extraordinary acceleration in price action, yet at the same time, technical signals are warning of deep maturity and potential exhaustion. It's a classic tension, really, between immediate momentum and systemic risk.
It certainly is. You've got these conflicting signals pulling in opposite directions.
Exactly. And the central question that emerges from the latest analysis is, I think, critical for anyone in this space. Does the current powerful acceleration in this mature gold and silver bull market primarily suggest that major market peaks are imminent, emphasizing a kind of timing constraint? Or does this acceleration indicate that significant price upside remains before the market finds its ultimate top?
A key question.
So I'll be arguing that the weight of technical maturity and these timing indicators suggest market peaks are arriving sooner rather than later, demanding risk caution.
And I'll argue that the sheer force of this acceleration phase implies there's still, much room to rise, driven by pretty powerful price discovery that we're seeing right now.
Okay. Well, I see why one might be captivated solely by the momentum. But let me offer a perspective rooted in risk and, frankly, systemic fragility. The analysis is explicit. This is a powerful but mature bull market. Now, in technical analysis, especially under the Wyckoff methodology, maturity combined with rapid acceleration, that's often a hallmark of the final stages, the distribution phase leading to exhaustion. Our market analysis currently assigns a Wyckoff rating of 8.0. Just for clarity, an 8.0 rating means the market structure is deep into the markup phase and is extremely close to the transition into full distribution, or what's commonly called the blow-off top. When a market hits this extreme maturity, timing risk becomes paramount. And crucially, we have specific technical evidence confirming this fragility right now. We saw a downward trending key reversal signal for silver on Friday. A key reversal is it's a powerful candlestick pattern where the market trades above the previous period's high, showing that initial strength, but then closes below the previous period's low. This is often the clearest hint that buyers have just been overwhelmed by sellers right at the top, and it frequently marks the exhaustion of the move. When you pair this specific signal with the 8.0 maturity rating, the timing clock looks much faster. The risk is specific and defined. The bear's target is a close below the firm support level of $46.70.
Okay, I understand the technical points, the Wyckoff rating, the reversal, but I come at this from a completely different perspective, really driven by the empirical price action itself. While I respect the rigor of timing indicators, I find it difficult to accept that fragility defines a market capable of this kind of, frankly, violent upward movement we've just witnessed. The fundamental reality right now is powerful, renewed acceleration, and it's supported by brand new record highs.
But is that sustainable?
Well, let's look at the facts. We are talking about gold sharply rising to a new all-time record level, now trading north of $3,815. That's a substantial increase from just last month. Silver, which often lags, also participated robustly, achieving a new 14-year high at $44.575. This is not some hesitant market. This looks like a market entering a manic price discovery phase. My position relies on that explicit caveat in the material. In the acceleration phase of mature bull markets, the price perspective dictates that significant price discovery must still occur. We have to follow the price action until the market structure truly breaks down. This momentum, it just screams much room to rise before any major sustained reversal can be logically supported, in my view. Consider the immediate, tangible bullish goals for silver. Technical resistance is charted at $52.00, then $52.50, with the ultimate high water mark for the bulls being a close above the record high level of $53.765. These are substantial price milestones, and the journey toward them seems to dominate the immediate investment horizon. That suggests the upside potential is still dominant over any sort of generalized timing worry.
Okay, so let's address that acceleration directly. The data clearly shows powerful, explosive acceleration. Gold setting a new record, silver hitting that 14-year high. This velocity implies, as you say, demand is dramatically outweighing supply, forcing an entirely new valuation bracket. How can one logically reconcile this demonstrated momentum, which is likely drawing in late institutional capital, with the belief that a structural peak is literally imminent? I mean, pricing feels far from settled, doesn't it? And the acceleration phase itself seems like a necessary mechanism to find that final highest resistance point.
I'm not convinced by that line of reasoning, because I think you're decoupling acceleration from its essential market context. Yes, the price action is spectacular, but we have to ask, who is driving this momentum, and why now? The source material describes this as a powerful but mature market that is accelerating, as I mentioned, that 8.0 on the Wyckoff scale. It suggests this acceleration is the final manic phase, the classic blow-off top. A blow-off top is characterized precisely by record prices achieved on vertical, unsustainable momentum, often designed to trap the last buyers who jump in because of, FOMO, fear of missing out. The analysis specifically warns that this rapid spike is an early hint that peaks may arrive sooner rather than later from a timing perspective. So the rapid spike actually confirms overheating. In my view, it doesn't confirm sustainable long-term growth. To put it simply, the faster it goes up now, the harder and quicker it likely falls later.
Okay, but we must put greater analytical weight on the specific, actionable technical warnings that speak to short-term structural failure. You seem to gloss over the Friday key reversal signal for silver a bit. How much technical weight should we really assign to this? This isn't some vague indicator. It's a specific technical pattern that analysts use precisely to flag potential exhaustion at a local high. Relying solely on the hope that momentum will somehow overcome established reversal patterns and the explicit warning of extreme maturity? Well, that seems like a profound failure in risk management to me.
That's a compelling argument regarding the reversal signal, I grant you, particularly its structural definition. However, we need to assess whether that single day's reversal is truly an indication of a major top or perhaps just a short-term shakeout. I'd argue it's more likely the latter, and the context of the support and resistance level seems to support that view. While the key reversal is noted, look at the immediate defenses that are still in place. The immediate support levels for silver are first at $50.50, and then there's a pretty major psychological and technical buffer around $50. Now, compare that to the bear's necessary objective, a decisive close below $46.70. That $46.70 level, it likely corresponds to a key structural pivot point, perhaps the 50-day moving average or a previous major consolidation base. The existence of these robust support levels, several dollars above the bear's necessary breaking point, suggests there are strong technical and psychological buffers that must be broken first. So the bullish price targets up near $53.765, coupled with these strong support defenses, it demonstrates that the market structure is far from having capitulated to that single technical timing warning.
But the key tension here, which the analysis explicitly defines, is the separation of time and price. The analysis seems to suggest that the timing risk, that sooner rather than later warning, is the primary factor we should be heeding in such a mature market, irrespective of those potential price targets way up there. I am positing that once the timing clock runs out, potentially signaled by that key reversal and amplified by the 8.0 Wyckoff rating, the potential price upside toward $53.76 becomes entirely irrelevant from a risk management standpoint. You seem focused on the maximum potential reward. I am focusing on the probability of achieving that reward before the entire structure potentially collapses. Our primary concern should be managing the highly elevated Wyckoff risk. The analyst is giving us, I think, a clear signal that the time remaining for appreciation might be critically short.
Possibly. That much room to rise caveat is critically important, precisely because the market is setting these new benchmarks. When gold hits $3,815 and silver sets a 14-year high, that's actionable data right now. If the analyst truly thought the top was absolutely immediate and definitive, they probably wouldn't highlight $53.76 as a critical bull objective still out there.
Possibly.
This indicates, to me at least, that the analyst views the possibility of significant continued appreciation as a dominant factor in the immediate term overriding the generalized, maybe somewhat vague timing warning. For a trader or investor, the immediate potential for movement toward that $53.765 silver target, driven by the current massive momentum, well, that's a far more tangible and actionable signal than a philosophical warning about the overall cycle's maturity. The market simply has not demonstrated enough price exhaustion yet to dismiss that tremendous upside potential. We almost have to chase the momentum until the support levels actually break convincingly.
Well, we must reiterate the importance of balancing momentum with risk signals. Heeding the specific localized technical signal, Friday's key reversal, especially in the context of the overall maturity rating of 8.0, is, I believe, essential. My position remains that the analyst's explicit warning about the timing of the peak in this mature market must define our strategy. The risk is substantial. If the final peak arrives faster than those remaining price targets are achieved, leading to severe disappointment for those focused solely on the 53.765 figure.
And conversely, the sheer force of the acceleration, evidenced by gold setting a new record high, north of $3,815, and silver hitting its 14-year high, suggests quite strongly that the market has not yet completed its upward move. The much room to rise price potential remains the stronger immediate signal, backed by immediate resistance and support levels that confirm the market is still structurally bullish, in the short term at least, despite its maturity.
The source material really forces us to confront this duality, doesn't it? It provides strong, specific evidence for both immediate caution and the continued potential for massive upside.
Absolutely.
It leaves the ultimate direction of this mature bull market in a genuine and fascinating tension. It requires us to weigh the, let's say, high probability of short-term structural failure against the admittedly high reward of continued momentum.
Precisely. A classic market conundrum.